What are the 10 rules when it comes to investing money? Rules that you should never ever break, things that you should always keep in mind, things that form our investment philosophy here in Informed Choice. I feel like I should be wearing a suit and tie in this video, standing against a green screen with the London city skyline behind me, because that's what other investment professionals seem to do when they talk about money and investing money. But I'm not. I'm sat in my car here in the Surrey Hills, not far from where I live. And in this video, I'm going to share with you the 10 crucial rules that form the Informed Choice investment philosophy. Coming up. Hi everyone, I'm Martin Bamford from Informed Choice, and in this video I'm sharing with you the 10 essential rules that make up the Informed Choice investment philosophy. Now, I joked in the introduction that I should be wearing a suit and tie and standing with London behind me to present this video. That's what we tend to see, isn't it, from so many YouTube videos that talk about investing money, that talk about wealth management. But if truth be told, that's not me, that's not really us at Informed Choice. We're not based in London for starters, we're based down in Surrey and Hampshire, but I haven't worn a suit for a very long time. I don't tend to wear a tie. I'm sat instead in my car in the Surrey Hills in a car park not far from my home to record this video and share these thoughts with you. But before I get started, I probably should share some credentials. I think I should validate why you should listen to me when it comes to investing money. So by way of experience, I've been a financial planner for 18 years, been in the financial services profession for 20 years now. I'm a chartered financial planner, which means I hold a variety of professional qualifications when it comes to this stuff. And I've written a book about investing money. My book, Brilliant Investing, was published by Pearson Prentice Hall and became a bestseller. I've also contributed a chapter to Harriman's Guide to Investing, along with some very well-known investment professionals, including the late Jack Bogle. So hopefully I've got some credentials when it comes to investing money, some reasons to listen to these 10 points. Within Informed Choice, I'm Client Education Director, but I'm also Chairman of the Informed Choice Investment Committee and responsible ultimately for the management of close to £500 million of client assets at Informed Choice. That's grown over the years. So when you listen to the 10 points I'm going to share, which form the basis for the Informed Choice investment philosophy, hopefully that comes with a little bit of experience and expertise and gravitas behind it. So that's the reason for sharing that set of credentials there. So getting into point number one, the first point in the Informed Choice investment philosophy, and that's that all investment decisions should be based on the consistent application of a robust process. Now, investing money should be about logic, not about emotion. It's essential to try and remove as much emotion as possible from investment decisions, both upfront and on an ongoing basis. So having a documented process, having a list of steps you follow and you follow consistently, is essential, I believe, to invest in success. What you don't want to find yourself in is a position where you're reacting to what's going on in the market and trying to convince yourself that this time it's somehow different. It's not. So robust application of a consistent process. Where we see other investors and other advisors making a mistake is when they come up with a completely new model for investing money every single time they make an investment decision. And it involves hopping and skipping around an awful lot rather than sticking to a tried and tested set of processes, to a well-worn path when it comes to investing money. So number one, that consistent application of a robust process. Number two on the Informed Choice investment philosophy is to diversify using mainstream asset classes. Now, when it comes to investing money, risk is such an important element of all the decisions you make. Trying to ensure that for the investment portfolio you create and manage, you don't take too much or too little risk. You take the right amount of risk. It's a Goldilocks thing, isn't it? My porridge isn't too hot or cold, it's just right. So when it comes to risk management, the best way to manage risk is through diversification. And for the Informed Choice investment philosophy, we talk about diversification using mainstream asset classes. So primarily equities, shares in companies, bonds, corporate or government debt, commercial property and cash. That's it, 4 different mainstream asset classes. Now, when some investors and investment advisors talk about diversification, they go off and they use alternative investment asset classes, things like gold and commodities and some other weird and wonderful things like derivatives, even weirder things like cryptocurrencies and Bitcoin. you don't need to go off the beaten track, off-piste into those alternative investment asset classes in order to gain diversification. And the great thing about diversification is you can still enjoy over the long term great returns, but being in different asset classes, which all tend to behave a bit differently to each other at different times, being in that diversified portfolio means that you reduce the risk and the volatility in the short term, and you make the investment journey a lot more comfortable. And if your investment journey is a lot more comfortable, then you're much more likely to stay the course, not react when you see bouts of stock market volatility. And longer term, that leads to investing success. So number 2 is diversification. Point number 3 on the informed choice investment philosophy, and I believe this is a point that many investors overlook, and it's a scientifically proven one, and that is the bulk of variance in investment returns from different portfolios comes not from picking funds or being clever about what level the market's at, but it comes from your asset allocation decisions. So the big strategic decisions you make with your investments about whether to be in equities or bonds or property or cash and which proportion to have in each. It doesn't come from picking a particular investment fund or a particular stock. It doesn't come from trying to time the market. Most of the difference in returns between different portfolios comes from those asset allocation decisions. And to explain that in very simple terms, you can pick the best equity fund or the middle equity fund or the worst equity fund, but if all equities are doing poorly that year, it doesn't really matter very much whether you picked a good one or a bad one. What matters is that you are in the most appropriate blend of investment asset classes. And there's been some great academic research on this one. The academics argue about the percentage of variance of returns that are determined by asset allocation, but it's a high number. Definitely the majority of returns come from that asset allocation decision. So really start by focusing on your asset allocation, worry about fund selection, worry about market timing and other smaller tactical factors much later. Get the big stuff right first. Number 4, and with that being said, it is possible, we believe, to add some extra value to your investment portfolio returns through tactical decisions. So tactical adjustments to the asset allocation away from the long-term strategic model, tactical adjustments in the way of fund selection as well. And we talk about this because there are times when certain asset classes, certain investment types look overvalued or undervalued in a historical context. And I think it would be foolish to ignore those overvalue and undervalue moments, because it's clear to see that there's a value opportunity or something is too expensive. And by making very small tactical adjustments, you can capture some of that value in the short term, or at least have the opportunity to. So we still believe the bulk of returns will come from the asset allocation strategy, but some additional value can be added through those very small tactical decisions too. Number 5, and this one's so important too, and that is to always relate your investment decisions to your financial plan. Everything should start with your financial plan. And to use a car analogy, because I'm sat in a car right now, your financial plan is the car and it's the destination you've plugged into your sat nav. The investments you make are the engine. It's the bit that's going to drive the car and move it along towards your destination. But the financial plan is the most critical part of the overall financial picture here. Don't start making investment decisions and picking stocks and picking asset allocation positions, etc., until you have a robust financial plan in place. So understand what your goals are in life, understand how much risk you need to take to achieve those goals, and then start thinking about making investments. Because we see so many investors who come to us in the first instance and say, I would like to invest my money for capital growth. And that is such a nothing investment objective. It's a meaningless objective. Anyone can invest money with the aim of growing it. But why are you trying to grow it? How much risk do you need to take? How much risk are you able to take, your capacity for risk, before you make those investments? So start with your financial plan and then make investment decisions that complement that financial plan and drive you closer to your financial destination. Point number 6 is that trying to time the investment markets is a strategy that is doomed to failure. Again, loads of research out there on this, that market timing is a fallacy. And actually what is really important is the amount of time you spend in the markets. So the best thing to do is to invest, to stay invested, and ignore the noise, ignore the short-term volatility and scaremongering that's associated with the world of investing. Because it's the 20, 30, 40-year return you're trying to capture, not what's happening this week, today, this hour. And there's so much news out there. We have a 24/7 news culture now. You can use social media, you can see second by second what is going on with different stock prices in different markets, different economies. But actually, if you try and react to that, you're going to lose out. You're going to be out of the market when it rises and probably back in when it falls. There's an equal chance of that happening as there is to the other thing happening, which is what you want. Point number 7 on our investment philosophy at Informed Choice is all about fund selection. So once you have your financial plan in place and you know about the investment decisions you need to make to achieve that financial plan, you need to populate that asset class model with investment funds. And there are thousands of investment funds to pick from in the UK, so this is no easy task. Now, fund selection at Informed Choice is down to 3 factors. Number 1, consistency. So we're looking for funds that perform consistently. We don't want funds that shoot the lights out one year and then crash and burn the next year, because that's typically what happens. Funds that have a robust, repeatable process employed by the fund manager, by his or her team, those are the ones we're interested in. So consistency is really important. Number 2 is risk-adjusted returns. So when people pick funds, they often look for performance, and they look for funds which have performed well. Performance is nothing without risk management, because you can take a huge amount of risk to get a level of return, or you can take much less risk, get the same return or even a slightly lower return. Look for the risk-adjusted return. That's far more important to understand than the headline figure. And then number 3 is low cost. And when it comes to investing money and picking funds, cost is one of the main things that you can control. The lower the cost associated with investing money, the more of your return you get to keep. So look for consistent risk-adjusted returns and look for low costs, and you should be able to select some fairly decent funds that do the job, do what they say on the tin, and actually achieve your investing objectives. Number 8 on the Informed Choice investment philosophy is that there will be surprises from time to time. Yeah, I'm recording this in 2020. There have been some big surprises this year already. So there will be surprises from time to time. Some people call those black swan events. But history is a fairly reliable way to inform us of what's likely to happen in the future, when it comes to investment markets at least. We know over the long term how the different investment asset types tend to perform relative to each other, relative to the economy. And that's the thing to look for when it comes to investing money. Try again not to focus too much on the short term when you're reacting to news and what's going on. There'll always be bad news. There's always reasons to be fearful about investing money. Always something coming down the track that will damage investment returns, investor sentiment. And the important job of the investor and of the investor's advisor, us, is to ensure that you ignore that bad news to the best of your ability. You weigh it up for sure, and you also try and think about the positive stuff that's going to happen. There will be nasty surprises. There will be another COVID-19 type virus pandemic at some point in our lifetimes, I'm sure of it, and that will have an impact on your investment returns. But try not to get too hung up on those. Try and think about the long picture, the big picture, the 10, the 20, the 30-year returns, and what investment types tend to do over those very long periods of time. Number 9 on the Informed Choice investment philosophy list is a little bit controversial in the world of investment advice, and that is that we believe that actively managed and passive investment funds both have a role to play in investment portfolios. There are circumstances where actively managed funds, the correct actively managed funds, can do the right job. So where there is inefficiency in particular investment markets, where there is specialism, for example, looking at socially responsible investing, then often an index tracker is not the right tool for the job. Now, index trackers are fantastic at keeping costs down, at delivering a market return, and that's really what you want them to do. But as I mentioned earlier, one of our points is that it's possible to add a little bit of additional value through the selection of tactical factors. And one tactical factor is an active fund that has what's called a high active share. So don't go for closet trackers, actively managed funds which charge you a lot of money and effectively just pick every investment in the market. Go for funds which are truly actively managed, that are reasonably priced as well. So don't go for high cost active funds, but ones that offer a reasonable price in terms of what they do, and understand what they do as well, but they can play a role in portfolios. We've been using a blend of index trackers and actively managed funds in our client portfolios now for well over a decade. And while the use of index trackers is growing year on year, there is still a role to play for these actively managed funds. And then point number 10, last but not least, and that is investors should understand every single part of their investment portfolio. There's no sense in investing money in things which are complex and convoluted, and you cannot wrap your head around, you can't understand the risks involved, you don't really understand how those funds or those stocks generate their returns. Understanding is such an important element, it's an essential element of investing money. And I think it's essential for all investors to know where their money is invested, what's likely to happen under different circumstances, different scenarios. And that's why we believe at Informed Choice in keeping things as simple as possible. There's a temptation in the world of investing to make it complex, to make it more complicated than it needs to be. Hence the big, shiny offices in the city, the suits, the ties, the smart appearance, and all the things we usually associate with wealth management, the double-barrel surnames. I don't have one of those either. So don't overcomplicate what is actually a very simple thing. Keep your investment portfolio as simple as possible, make it as vanilla as possible, and then you tend to avoid all the nasty stuff, all the unwelcome surprises, all the scams, all the high costs, all the esoteric investments which go wrong. Keep it simple, keep it on the beaten track, and you'll have a much, much nicer experience of investing your money. So those are my 10 rules for investing money. They make up the Informed Choice investment philosophy, which has served us and has served our clients incredibly well for well over a decade now. I hope you enjoyed that video. I'd love to hear from you in the comments below what you think of those rules, what rules you've set for yourself when it comes to investing money. Please do leave this video a like if you found it useful, and make sure you subscribe to our channel for more videos like this in the future. Until next time, I'm Martin Bamford, and when it comes to your money, the more you know, the faster it can grow.